Welcome to Idea to IPO. Hello, I'm Jennifer. Idea to IPO has been hosting tech startup events in Silicon Valley for many, many years. We organize venture capital, panels, legal workshops, networking events, and more. These days, we are 100% online. Check out our schedule at ideatoipo.com. Our featured speaker is Roger Royce, one of the top venture capital attorneys in Silicon Valley, and he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Roger Royce. Roger, take it away.
Okay, thanks very much, Jennifer. And by the way, that's the first time I've been introduced by Miss Fitness or future Miss Fitness. Okay, I'm going to remove your spotlight, and that should leave just me. There we go. So thanks everybody for joining. My name is Roger Royce. I'm a partner with Haynes & Boone. We're an international law firm based in Palo Alto. And thanks for being here for this event. This is how to prepare your startup for venture capital investment. I've been gone for a while. We've taken a little bit of break during the summer, but we're coming back. We'll be doing this again next week as well, by the way, with another presentation on energy tech. So make sure you check the Idea to IPO website. I would like to thank Idea to IPO for hosting this event and allowing me to be your speaker and also your technician, it appears. So you got to bear with me here while I make all of this work. A couple of housekeeping items before we get rolling. Number one, use the chat feature. The chat feature is awesome. It is like being in person. You can talk to people, you can talk to me, you can talk to other attendees. I am going to share my LinkedIn profile and some other information for you in the chat feature so you can see how it works. Make sure that you find my YouTube channel, which I did not yet post, but I will, because this is going to be recorded and posted on my YouTube channel along with about 100 other programs like it. So we have tons of content that you can access if you just go on to the YouTube channel, which I will give to you later on. Secondly, use the chat feature if you want to talk to each other. Use the chat feature if you need to get my attention immediately. Use the Q&A dialog box if you want to ask me a substantive question that we will address after I get through the presentation, which, as you know, because you've all been here before, I'm sure we're going to do for an hour. Then we get into the Q&A. So save up lots of really good questions and we'll get to them. As I said, the slides will be available. You'll be getting an email with the slides. Don't email me about that because they'll be coming. Email with the slides after the presentation, an email with the video, and you even get a copy of my book, Dead on Arrival, How to Avoid the Legal Mistakes That Could Kill Your Startup. Now, I'm going to tell you here, you are hearing it here first before anybody else. I've been threatening to write a second book for many, many years now, ever since I finished the first one several years ago. And this last 4th of July, thanks to a cycling injury, I actually finished that second book. And it's in the editing process now, and it's going to be out this year, hopefully soon, certainly by Christmas. It'll be just in time for Christmas. You know, it's a great stocking stuffer. You know, you're looking what to get for that hard to buy for person. Well, just let you know there's a book coming out. But I'm going to give you a free digital copy of this one along with the slides and the video of this presentation after this is over. Okay, let's get rolling here. Make sure you tweet to hashtag #IdeaToIPO. Again, check out the LinkedIn site, the webpage, the Twitter page, the YouTube channel. Now, before we get rolling, this will inform my presentation if you can tell me a little bit about who you are. And for example, are you a startup entrepreneur? Are you from an established company? Are you an investor? Are you a service provider like me? Are you an academic, student or instructor? Are you in government? Are you a paparazzi? Whatever you are, fill out the, take the poll. Wow, a lot of entrepreneurs here today, almost all entrepreneurs. I guess we got some people from established companies, I guess shopping, I guess, but about 80% startup entrepreneurs. I want to leave it open for only half of you have voted. Oh, come on, humor me. Smash that button. Tell me who you are. People are being stealthy. I'm telling you, you're just cheating yourself out of some really good targeted information. The more I know about you, the better I can be. Okay, 80% startup entrepreneurs, not a big surprise there. I'm not quite done asking questions yet. This one's even as important. Where are you from? And by where are you from, I mean, where are you right now? Are you in Silicon Valley where I am? You'll notice that I'm very close to, which way? That way, Sand Hill Road, which is in Menlo Park. I'm actually not outside right now. That's a photograph, but I actually am sitting pretty close to that sign. In the heart of Silicon Valley. You folks, it looks like a quarter of you are from Silicon Valley. Half of you are someplace else in North America. Some of you are from Asia. We're not well represented anyplace else. South Pacific, yes, thank you. Africa, thank you. You know, it's interesting. We get more and more Africa representation, it seems like, as we do this. And I think there must really be something going on in Africa in the startup world, because I'm just seeing more and more activity from startup companies from Africa. So that's great. Okay, I do believe that I have covered all of the housekeeping introductory materials. And now it's time for the technical portion of the program where I share my screen. And use the chat button if you don't see my slides, although I'm quite sure that you do. All righty. So the presentation tonight, how to prepare your startup for venture capital investment. All right. First thing I want to tell you is that I am a lawyer. I am not your lawyer. So this is me talking. This is not me being your lawyer, because that requires somebody to talk to you specifically about your specific facts, because the law is very fact specific. You change the facts, you change the result. Having said that, I am going to talk to you about one of my personality defects is that I am a lawyer. So you're going to get a lot of law and as well as lore here tonight in the things that I discuss. And keep in mind, these are generalizations. They're certainly true, but they're generalizations. We don't know if they apply to you. So how to prepare your company for venture capital. That is a picture of a venture capitalist there. Usually I put a big picture, scary picture of a shark up, but given that this is Shark Week, I just don't think it's going to have the emotional impact that it normally would. And by the way, thank you all for being here tonight, during Shark Week. I know there's other places you'd rather be, but venture capital represents money for most of my clients and most of the people I know. They think venture capital, they think of the monopoly man, and they think of money, and for good reason, but there's a lot that goes into it before you can get to that point. And that's what we are going to be talking about here tonight. So let me give you a little bit of background before we kind of get into the real meaty part of this. First of all, I love this headline from Crunchbase News last week, or it's been a week ago now. Global venture funding hits all-time high. $288 billion invested. That's incredible. Those are incredible numbers. 2020 was an all-time high year, and we are smashing that in 2021. There is a tremendous amount of venture out in the market right now. So this is a great time to be going after venture capital. Let me give you a little bit more detail here on this. See, like I say, 2020 was a historic record, $130 billion, but we're smashing that in 2021. Here we are, first, this is after Q1. We already had $62 billion of investment. And this is from the PwC CB Insights Money Tree. Let me give you some data from another source. This is from Crunchbase News. Just this week, actually came out with this. And they're showing that 2021, you can see what a huge growth we've had. Look how much money, just look at how much money compared to prior years is being invested. It's incredible. And a big chunk of that, of course, is going into early stage. You're seeing more of it in late stage as you see VCs double down on investments they've already made. But early stage is still going up. I'm going to put that in my next polling question. Are you late or early stage? But I'm guessing most of you folks are early stage, and these are good times for early stage. Late stage, as I said, is up 103 billion in Q2 of 2021. But let me show you again early stage. Through Q2 of 2021, $43.4 billion. Number of deals. You can see it's an upward trajectory. So that ought to tell you something. Seed and angel investments, numbers are high, 6.3 billion. This is all Crunchbase. And then I gathered a couple other numbers for you. We don't have a lot of people from Europe here, but I want you to know that this is not just a Silicon Valley thing. This is not even just a North America thing. This is a global thing, because look at what's going on in European venture. It's just really exploded in terms of 2021 venture investment in Europe. And I don't have Asia numbers, but I'm sure you will find the same trend throughout the world. And again, early stage is on the increase, and it's as high as it's ever been. Seed and angel investment as high as it's ever been. Here's an interesting statistic. Where's that money coming from? Just look at the UK. That's the blue line. A lot of the money is coming out of the UK. There's a lot of UK investment. Germany is second. Sweden is third. France is up there. France, see, I'm drinking my French water in honor of, and see if I got the right color, in honor of France being on the list. And then the Netherlands, of course, that's where the money is coming from. So this is a global phenomenon. So for those of you who are not here, just keep in mind there's a lot of money around the world. You're probably not that interested in rounds 100 million and above, but those have increased. We've had lots of new unicorns. This data is a little old. This is back to February. And I'm going to not pause on this because you're going to get the slides later. You can go ahead and take a look at it if you like. So venture-backed acquisitions, that's the other thing. I'm doing a lot of M&A right now. It's a very strong M&A market. It's not only frothy in investment, but we're also seeing lots of companies deciding now is a good time to exit. And all right, so before we get into that, where do I want to pause on this? I don't have a slide for this, but I do want to mention some of the things that are going on that's driving this. So it's a strong M&A market. I believe because people are a little nervous about what's going to happen. If you saw the numbers just today, we're in an inflationary period. All the economists say they think that's temporary. I'm not so sure. I don't know. I don't know what the Fed's going to do, but companies are nervous enough that I'm seeing them more wanting to exit now than they have been for a while. And that's one of the things that's going on. That's driving some of the activity in the space, because exits are good for investors. People get liquidity. There's a lot of cash moving around in the system, et cetera. The second thing you ought to be aware of is that even though there's a tremendous amount of venture capital, there's a lot of other money in the system as well. I mean, a lot of companies are still living off the federal, here in the US, off the federal money, the PPP loans, most of which has been forgiven or is forgivable. A lot of companies are living off that. On top of that, the laws have changed, and maybe we'll get into this if we have time, that make accessing money from other sources relatively easy, in particular crowdfunding. I'll talk about that later, I hope. So there's a lot of money from a lot of different sectors coming into the market. And why am I telling you all that? Because I just want you to know that not only is there a lot of venture money, there's a lot of competition, right? So you're in a pretty good space if you're dealing with investors. So let's talk a little bit about preparing your company for venture capital. What I just gave to you were the trends in terms of investment. Where is that money going? And what will it take for you to be able to attract venture capital? And by the way, I'm seeing things now that I've never seen in my career, and I'm extremely old, so I've been doing this a long time. But I am seeing things happen. I'm seeing companies get meetings with VCs that normally you'd say you're too early for that meeting, but they're getting the meeting because they're checking other boxes. And one of the big boxes that is getting companies meetings, I mean, sit down meetings with top tier VCs that are household names for companies that haven't raised a dime. I'm not making this up because they check the right boxes. And one of them is just ESG. What do I mean by that? Right? Environmental, social, or governance. That's ESG. And that can be responsible impact investing, sustainable, climate change, save the world, save the environment type technologies, and also diversity. So let me talk a little bit more about that. What does that mean for you? The last slide defines what ESG is. It's socially good companies, impact companies. What does that mean for you as a company? It means if you can fit yourself under one of those categories, you're going to be in a much better place for purposes of getting that pitch meeting. And one of the things that I'm seeing pop up now in deals, even for startups, are a requirement of having compliance procedures and policies in place. Now, my law firm does public company stuff. We're used to this. The SEC is about to mandate this, in fact, for public companies, or at least a disclosure. So we're familiar with these concepts in bigger companies. Startups have never thought about this stuff before, not in my experience. And now they are. Now they're having to think about it. Gee, what are you doing to ensure, that you've got good compliance or you've got good policies? And it's becoming important because investors, they want to be able to tell their investors that they're being socially responsible. Some of the other things you should always think about, of course, is AML, anti-corruption, KYC. It goes hand in hand. That's know your customer. And AML is anti-money laundering. Yes, thank you. So it goes hand in hand. If you're going to put in place good policies, you might as well put in place these policies as well. Good governance. They're part of good governance. The other thing that I want to mention that seems to be back in vogue is distributed ledger or blockchain technology. I think the COVID pandemic showed us the fragility, we'll say, of the supply chain. There was a lot of opportunity for blockchain to make inroads there. And I'm just seeing those companies becoming more interesting now than they have been in a long time. I don't know why. Maybe it's just what I'm seeing. It's anecdotal, but it just seems to me that they're more interesting. At the same time, however, we're seeing the volatility in crypto, which I'm sure has got to be scaring a lot of people. The SEC has been cracking down, and under our new chairman, Gary Gensler, I can promise you they're not going to make life easier, not one little bit, for anybody using blockchain to trade in securities or that is trying to tokenize their products and sell them. In fact, there just are ICOs in the US. That is so yesterday. It's just not happening anymore in the US. And I think there's a lot of fear. And there have been some big recent enforcement actions by the federal government against distributed apps, for those of you who are in the space, where they're holding the principals responsible for unregistered exchanges. So there's a lot of fear, a lot of uncertainty, and that's what's working against it. On the other hand, we've seen the rise of NFTs, non-fungible tokens. It's a new way of monetizing your art or your product or your whatever that asset is. You digitize it, and the difference between an NFT as a token and other types of tokens is that that particular code is tied to a specific asset, and that represents ownership of that asset. And it could be an undivided interest in an asset, like a piece of art. That's where we're seeing most of it, and that could be huge. That could be a very, very big thing. So it's a little bit of a mixed bag, but I have been seeing more interest in blockchain lately. If you're really interested in NFTs, I'm not going to spend any time talking about it now. Go ahead. I like this article from The Verge, NFTs Explained. I think they do a really good job. It's sort of a lawyer's playground when you get into this, because there's all these unanswered IP issues. Who owns the copyright? How are you going to enforce it? How are you going to know when somebody's infringing? All this stuff. But it's worth taking a look at as a potential revenue stream. Now, what we've seen over the last year or so is that there have been some winners and losers throughout what's gone on the last couple of years. And what I think is really successful now, and this is a short list, it could be a much longer list. In fact, I don't even see some of the big ones on here that we've come across. Well, housing, let's call it real estate tech generally. One of the sleepers that seems to be doing really well. I don't have AV, no, there it is, AV. Another one, the technology is catching up, and AV, autonomous vehicles, had a little bit of a slump a couple of years ago. It's really coming back. So if you're an AV or anything related to that, LiDAR, artificial intelligence, all of, even AR, because people have got to be entertained while they're being driven around. AV I think, is going to be a growth sector going forward. And then there are the obvious ones, cybersecurity. We all saw what happened with the recent food hack and our recent energy supply hack, and everybody is hyper alert. I do a lot of work with agriculture. I've been saying for many years, just a matter of time before our food supply gets hacked, because agriculture is becoming more and more wired, and they may not be as sensitive to security issues as the rest of us have learned to be, who've all been hacked at one time or another. So we had one big food hack, as you know, a few weeks ago, and that is an industry that people are paying attention to. What else? Precision medicine is always important. COVID did a lot for precision medicine. It got us all used to talking to our doctors through video chat. We don't have to drive down and see them. In fact, I don't know if it's a good thing or not. Especially if you're a hypochondriac like me, I'm calling my doctor all the time to complain about this and that. And I keep having to remind him. I said, even hypochondriacs can really be sick sometimes, so you better pay attention. All right. In fact, that's going to be on my tombstone. I'm going to say, put right on there, I told you I was sick. And the other one, transformative tech. This is a term you might not have heard before, but transformative tech is kind of everything. Wellness, health, you're seeing a lot of technology around that, anything that uses technology really to make our lives better. Why am I pausing on this? Because even 500 Startups now has announced an initiative in transformative tech. It's kind of made the mainstream, and I've heard of funds being formed to invest in this sector. So if you keep your eyes open and you're good at Google, you'll find what seems to be hot right now. But again, with all the money that's out there, I'm not sure there is a bad sector. Bill Reichert from Pegasus Capital is a frequent guest of Idea to IPO. I did a panel with him recently, about a month ago, 6 weeks ago. And Bill made the comment, he says, almost anything is investable now. He said, we used to joke that we would not invest in we'd invest in anything but a nail salon. But once there's a nail, it's not exactly a nail salon, but a company that does nails that basically got venture capital funding last month. I don't know the name of it. If you Google it, you can find it. But the point being that almost anything is fundable as long as it's scalable. We'll talk more about that in a minute. So let's go through a couple of basic principles. Now we'll get down to some of the meat of it that you should keep in mind as you prepare your company for venture capital. And the first thing, and it's not just VCs, it's whoever your investors are. And I keep having to remind people, your investors really are your partners. It's like a marriage you can't get out of. I mean, once you have somebody as a shareholder in your company, you are pretty much stuck with them until you exit. Now, yes, there are freeze outs and there are these things that people do to get rid of minority investors. Trust me, they're very disruptive. They're very difficult. You expose yourself to significant litigation risk. As a general rule, you ought to be planning on staying with an investor for a long time once you take them in. Just keep that in mind. For anybody, you should be doing background checks. And if it's a VC that you're talking to and you're thinking of taking on as an investor, you definitely want to go Google them and find out what their reputation is. Here in Silicon Valley, it's easy to know this is a small valley. Everybody talks. We all kind of know what personality venture funds have. It keeps them sort of honest, I guess. But now look at our audience here is 50% outside the valley. The investment community is also getting widely dispersed. I don't know, someday it might become more anonymous, more New York City-like, where you're never going to run into the same person twice. So like Dostoevsky said, everything is permitted. We're not there in this valley. You can still find out what people's reputations are. Make sure you do that because you're stuck with them. Let me pause on that for a minute. What do I mean by that? Some VCs are notorious for being difficult to work with. And by difficult to work with, I mean it's hard to get the later investors come in because they won't negotiate with them. They won't give up, their positions. You don't want those VCs. You want the ones that know everybody and are used to doing, being involved with lots of follow-on rounds. So, just know that some VCs are, their MO is that they're going to replace the founder or CEO. That's not necessarily bad. Usually it has to happen eventually. You just got to know that. Just know that going in so you don't have any misplaced expectations down the road. You can find out all about this stuff, just by doing a little diligence. Secondly, stage your financing. This is a conversation I have a lot. And in fact, I don't know why I have to have it so often. It seems kind of obvious, but you don't want to take all the money in the world early on. You want to take just a teensy tiny little bit, just enough money to get you to your next valuation metric. Why do you do that? Because your money is so expensive. That's why. Money's expensive, and it's more expensive the younger your company is. So you want to take small amounts of money when your valuation's low to get you to a next valuation point. And then you can take another tranche of money when your valuation's a little higher, but just enough to get you to a next valuation point. And then you take a little more money. I can tell you, as counterintuitive as it is, the most successful companies I've ever worked with are the ones that are really stingy about giving up their equity when it comes to investors, because they know, that they want just enough money to get them to the next valuation point. In fact, the best companies I've worked with were the ones that refused to let me, their lawyer, buy into the round, believe it or not, because they knew that what they had was worth more than money. Funding is dilutive. Just get used to it. Just get used to it. You're going to get diluted. Because once in a while, founders will say to me, yeah, let's do this, but I want to keep this number of shares, and we'll try to hardwire in some sort of mechanism that'll keep them at a certain amount of shares. Just forget about it. You are going to get diluted as you take in more money. You're getting a smaller percentage of a bigger pie. So don't let that freak you out. Now, having said that, you really do need to pay attention to how much that dilution is, because there is a floor. There is a floor beneath which you, the founding team, cannot dip below. There is a certain minimum amount of stock that you have to have in your company, not only so you're happy about it, but so that the investors know, the later investors know, that you're going to be properly motivated to stay with the company and drive it towards exit. So keep in mind, funding is dilutive, and just know what your dilution is. I'm going to talk more about that in a minute. Another basic principle, everybody is so hung up on valuation. And I think a lot of it's tied up in ego. And the way I look at it is a little bit different. Valuation is just a number. Valuation is just math. It has nothing to do with what you're worth. It has everything to do with what the investor expects to get on the back end when they exit, because that is how they're thinking about it. They're thinking about that big exit. So the other thing valuation is good for is, again, determining how much the founders are going to be incentivized to push the company towards exit. So even though I have a memo that has 30 different ways to value your company, sounds like a song, doesn't it? There's 30 ways to value your company. And I'm happy to share that memo with you. It's not going to do you a lot of good, because those are all formula that everybody uses to come up with really a self-fulfilling prophecy, because they know what percent of the company they want, and what percent you, the founders, have to hang on to. Poof, there, and how much money you need. Poof, there's your valuation. So don't get too hung up on it. just think of it in terms of math, because your valuation is going to be way higher when you exit than it is now. It's just a way of allocating the equity on the front end. It's also not your biggest issue. We're probably tonight not going to get to actual venture capital terms. We do a whole presentation on that, but valuation is just one piece of a much bigger puzzle with a lot of different terms that will determine how much you get at exit. And by the way, that's what you're really focused on here, is when your company exits, when you do your M&A, like a lot of my clients are doing now. You know, I've got companies now I'm working with that have been with me. I've got one that's been with me more than 20 years that we're in an exit scenario now. Do you think it mattered at all what their valuation was 20 years ago to today's exit? Not at all. It only mattered with respect to dividing up the equity between them and the investors back then. So think of it that way. Avoid early mistakes, obviously. Take cheap money over expensive money. What in the heck do I mean by that? It has a lot to do with how much of the company you're giving up, but more to do, or a lot also to do with what sort of rights you're giving to the investors. And it's either economics or control. We'll talk about that. Please preserve your common stock only for service providers. Don't sell common stock, that's the residuary, in order to raise money. Sell preferred stock to raise money. Preferred stock costs this much. Common stock costs this much. Preferred stock costs this much, so you're going to give up a lot less of it for the cash that you receive than the common stock, which costs this much. Why does it cost so much more? Because it has rights and preferences that hopefully will never be triggered, but mostly a liquidation preference, meaning the preferred gets its money back first. That's why it costs more. That works for the investor's benefit because they have downside protection. That works to your benefit because you don't have to give up so much of your company when you take outside cash. Get a data room, just one of those. Wear sunscreen, get a data room. Those are my two best, words of advice. It'll just make your life so much easier. My practice now is that everybody I deal with, first thing is get a data room. I don't want to have to spend hours searching through those emails to find that document you said you sent to me. No, by data room, I mean like a Box account, like a Dropbox account, like a Google Docs or a Google Sheets account, someplace where everybody can store documents. Maybe not Google Docs, but you get the idea, where you store documents and you can all see the same documents. And we don't have to do it like we did in the 90s, where we just email stuff around and hope that we're all looking at the same thing and nobody's changed it. And let's do our cleanup ahead of time. As a lawyer, I really want you to be kind of ready and raring to go and really to, take that money as soon as they say go. And there's always cleanup. There's always diligence. There's always I's to dot and T's to cross. Sources of funding, we're going to talk about venture today. So I'm not going to spend more than a few seconds on this, just telling you there's a lot of other kinds of money out there. I would love to tell you about SEALs because I'm seeing more and more of that. That's royalty financing, but we're not going to do that now. Maybe we'll do a whole presentation on it, but I've done several SEAL deals lately. All right, I will tell you about it. It's basically you got a revenue stream. You tell the investor, Mr. Investor, if you give me $100 today, I'll give you 10% of the revenue from this product for the next 10 years or something like that. It's out there. It's been around forever. It's more prevalent now. There are some very prominent investment funds and VCs that are promoting it, and you're going to see more of it. Think of it as debt on your balance sheet. When you do go to the VCs, that's how they're going to look at it, but it is an option. Sort of like factoring, but not quite. Where does money come from? Founders, they rely on their personal savings. You got to have a little of your own skin in the game, but not too much. Enough where you're committed, not so much you're going to do anything crazy. Angels, I'm going to jump ahead, but these are just anecdotally what I see. When I think of angels, I think of people putting 25 and up in. I think of angel groups as doing $250,000 to $1 million. Early stage VCs, you got to be in the millions before you. VCs will invest less money, a couple $100,000, just so they can get in on the real round. But that's not why you go to a VC. You don't go to a VC for a small round, right? And then when we think of VC rounds, we usually think 10 million and up, but certainly they'll do the smaller ones. And there are so many VCs doing seed and early that we do a lot of early stage VC investing. So the first thing, I'm going to jump ahead and talk about talking to the VC before I talk about how you get there. But when you do pick your lead, and by the way, you are going to pick your lead. You are going to do your research. You're going to find out they're not hiding. The greatest CRM system in the world is called LinkedIn, and you can find out as much as you need to know. Or also, Crunchbase has a good database. PitchBook has a good database. They're out there. These people are not hiding. You can find out who it is that, number one, has dry powder. That means money to invest. They're not too late in the fund, so they'll stick with you for a while before they start pressuring you to exit. And what it is they invest in. Do they do early stage? Do they do companies in your space? Are they in a space? And are they in your competitors? That may not be a good thing for obvious reasons. So you're going to pick a lead, and you're going to go find out who it is. Number one, you want it to be smart money, right? You want it to be somebody that understands your business. So you're not, because they're going to be part of your management. By the way, just get used to that. A VC is going to want to take a board seat. They're going to be right in there with you. They're not just passive investors. That's not how VCs work. They are venture capital strategy, which means they're offering you more than money. They're offering you smart money. They're going to provide you with maybe some past liquidity, maybe some really good introductions, maybe other money, other investors, maybe some industry expertise. Chemistry, find somebody you can get along with, goes without saying. Commitment, make sure that they're going to be with you for a while. You really like to know that they can, and this goes along with deep pockets, they can do the follow-on round. It's a bad thing, or at least not a good thing, if you do a Series B and none of your A investors will participate. Doesn't send a good signal to the market. I mean, it's not necessarily a bad thing. It's just not a good thing. Let me put it that way. It's something you're going to have to explain. And hopefully someone with a really good, strong network that can connect you to all the right people. I'm not going to talk about debt financing, government grants. We all know friends and family. We talked about that. Outside money, how much to raise? Let's just pause on this for a minute. When you go to outside money, whether it's venture or anybody else, what I said about stage financings, let me drill down on that a little bit, enough to get you to the next metric. Well, what does that mean? I mean, you're going to have to get familiar with a few terms, like burn rate, like how fast, quickly are you going through the money? Runway, how much time, how much do you need to get you to that milestone? I don't know, FDA approval or getting the product into the market or securing, a major customer, whatever it is that raises your value and proves your worth. So think about that in terms of how much to raise and not a dime more because you don't want to go beyond that. That next valuation event, you want that valuation event ideally when you're projecting out to double your value, right? That's what a valuation event is. It's something that's so significant it's going to double your value. Doesn't always work out that way. Probably usually doesn't, but that's what you're aiming for. That's your target. You also typically would like that to be 1 or 2 years away, right? You don't want to take money that's going to last you more than 2 years. If you have, you've probably taken too much money at too low a valuation. That's a gross generalization, but in my world, tech startups, it tends to be true. And you don't want to take money at too high a valuation. How counterintuitive is that? You don't want to take money at too high a valuation. Why in the world would I say that? Because that means that the next round might be at a lower valuation because you priced your company too high and it took the market a year to figure it out. That's called a down round. That's a bad thing. If you do a down round, first of all, you're going to trigger probably rights and preferences that the venture capital negotiated for themselves in the prior round. But secondly, you're telling the market that something's wrong. Something went wrong. You're telling the market that everybody miscalculated. And you'd rather not have to tell that story. The simpler, the better. So when you're comparing term sheets, if you're ever lucky enough, valuation is just one metric. You might look at all the other stuff that goes into it. And you might be willing to take a money at a lower valuation in exchange for fewer preferences. I've done that deal many times where I've said, look, guys, I know this sounds stupid, but lower the valuation and have them give up some of the other rights and preferences they have. Because if you map it out on paper, you find out that these rights and preferences that get into these term sheets, if it's not just super vanilla 1x non-participating or something, could really eat up the valuation. It could take more of your company. I'll show you what I mean in a minute. All I'm saying is valuation is not your biggest issue, and you don't want it to be too high. Let me just explain that just for a few more seconds more to make sure we understand this. A valuation can be artificially high because the VC gets it back on the back end through other rights and preferences. So for example, if the VC has a right on exit to take several times their money back first before you get any of your money, well, they might be willing to do that. They might be willing to give you a high valuation if they got that big preference. And yes, there are famous examples of companies having high valuations, but then they've come to an exit and the founders get nothing out of it, right? They get nothing out of it because of the multiple X preferences that the VCs negotiated. So you want to be careful about this, that you got the right number. And you have the right number as well as all the other terms. Executive summary, that's my template. It's just short, sweet, simple. Start with an executive summary. You should all have this. I know you've all got this humongous pitch deck that you put together, and we could spend 90 minutes going through if you let me. You should spend 10, but I know you could spend 90. And that's great, but start with the executive summary. Just at a glance. At a glance, are you in our space? And I know that's contrary to everything that everybody who ever took a sales course learned, but that's just a better way to approach venture capitalists, because this is not really sales at all. They have to go convince their committee, and their committee is just going to know that you hit these metrics. So let's just find out right from the start if you hit the metrics, right? Do you have a team? Do you have an impressive team? The VC, why are they so focused on team? I'll tell you why. Because whatever you're doing, I know you don't think you have competitors, but your investor thinks you do. They might not be around today, but they'll be around tomorrow. And they might not be doing exactly what you're doing, but they're doing something like it. So I don't tell people worry about competitors. I say think about the alternatives. Who are the alternatives to what you're doing? If you think of it that way, they're out there. And as soon as they're out there, the investor is going to be thinking, is this the best possible team to execute on this plan? Or is it a different team that can execute on this or a similar plan? So you want to make sure you convince them you have a team that they're happy with and they're impressed by. Projections, they always go in a summary. I wouldn't get too freaked out about projections. Everybody knows that there's a fair amount of fluff built into that. And by fluff, I mean optimism, we'll say. Market. Let me pause on market for a minute, because I've been telling people for years it's got to be a huge market. And that's what I've always thought, and that's what I've always read, and that's what I've always heard VCs say. But I was corrected recently by a very famous venture capitalist who said, stop telling everybody it's got to be a huge market. I got all these people walking in my office with their pitch deck. They spend all this time telling me how big the market is. That's not what I care about. I know they talk to you because they talk about the big market size. What I care about is how big the company can be. So that sounds like a subtle difference, but let's pause on that. The VC wants to know that the company can be huge. So even though buggy whips might not be a big market, maybe this company, has some way they figured out to make buggy whips a huge company. That's the most extreme example I can think. A better one is the nail salon, right? Maybe not a huge market for a VC, but somebody figured out how to make nails a big company. So that's what they're really looking for. So when I say market size, I'm going to change that slide. I'm going to call it company size from now on, because that's what I really mean. IP is important. If you've got it, if you're a tech company, you have, and by intellectual property, what is it that keeps other people out of the market and gives you a monopoly on what you're doing? And then something about the industry, of course. In your pitch, and again, sorry that I'm still up here in the platitudes and not down into the specifics. We're going to get there in a minute. But in your pitch, one last thing I'll leave you with. in terms of platitudes is, who was it? Whoever knows, put it in the chat. Some famous VC. Actually, I remember who it is, but I'm still going to let you chat it to me. Some famous VC said he wants to sell aspirin, not vitamins. In other words, he wants to solve real problems that you need a solution for right now. You need to have this. It's not that it's nice to have or you'd like to have, right? So think of a solution like that. That's what VCs want to see. Why is it they want to see that? Because that's the thing that might give them that explosive growth that they need to make the kind of money that they need to have. All right, let's kind of drill down. We talked about, these are some of the valuation methods that I had talked about. And like I said, I've got a memo. Text me if you want to see the memo. I don't want to get into it too much. I want to get into some other things. So I mentioned that there's a lot of other money in the system, and I want to pause on one of them. Reg CF equity crowdfunding. In 2012, the Jobs Act was enacted. Obama was president. We had a Republican Congress and a Democratic Senate. You may remember that year, somebody won the Kentucky Derby. I forget who. Anyway, that year we also got crowdfunding. And at the time, and for the last 8-9 years, you could have sold up to $1 million of securities in a 12-month period to non-accredited investors, anybody who was on a platform. It was in small chunks, $1,000, $2,000 at a time. So you'd have 1,000 and hundreds of investors on your cap table, but you would have raised your $1 million. It would have cost you a lot of money. It still will. Sometimes you have to have audited statements. Sometimes you have to file a business plan. There are registrations. So there are lots of good things and lots of bad things about crowdfunding. The biggest bad thing about it is that it was only $1 million. And I used to tell people, why bother going through all that effort for $1 million? And I'd say, don't do it. It's too much trouble. And they'd say, well, that's like you're telling me I need to be taller. What am I supposed to do with that information? What do I do to raise the money? Well, the discussion's a lot easier now, because now you can raise up to $5 million through equity crowdfunding. And that's worth it. For $5 million, it's worth it. If you've got a product that the market will accept, you can go out and sell. Crowdfunding is something you should consider. I'm getting to my punchline in a minute. Bear with me here. The second thing I want you to know about this is we've got this thing called testing the waters. So it used to be you couldn't go out and publicly solicit a crowdfunding sale. Even though people did it, they weren't supposed to. It could only be offered through the platform. So you didn't know if people wanted to buy your stock until you got onto the platform. And then if it failed, oh my God, the whole world knows you failed. Well, now you can do this thing called testing the waters, where you can actually go out and ask people publicly and say, hey, I'm thinking of selling some securities. If I did so in a Reg CF offering, would you buy some? And that's not an offering. And if you get some good enthusiastic response, then and you can do your Reg CF, your crowdfunding offering. So this is awesome. This is great. But the third thing is the biggest thing. The reason I told you that was to tell you this. The VCs have come to accept this. They've come to accept this. And there have been some other changes in practice. There are custodial arrangements, SPVs, et cetera. But early on, I talked to VCs and they'd say, my God, I'm not going to invest in a company with 1,000 common stockholders. They're, especially unaccredited stockholders. They're all going to sue me. They're unsophisticated. They don't understand, the risk, et cetera. Well, the VCs have come to accept this. And we've come to figure out ways so that all of those hundreds of stockholders can't mess up your governance like it was problematic before. So I'm just saying this is a much more viable option. And you don't have to worry about messing up your company for later venture anymore, like we used to all talk about. I think it's viable. And I know there are people out there that will disagree with me. I know there are VCs, I can think of some of them now who will disagree with me. But I will tell you, I know of a lot more companies that have done Reg CF and then did institutional capital. So there you go, proof's in the pudding. Rule 506, this is accredited only offerings. We all know about that. I want to jump ahead. Royalty financing, we already talked about. Just keep in mind, I like this if that's all the money you need. Be careful about this if your path is venture financing, because think of it, I know you might want to think of it as a pre-sale of the product. I think of it as debt. And I think the investors are going to view it as debt. And debt is not a great thing, if you get a lot of debt on your balance sheet when you go out to the investment community, because debt sits in front of the venture return. So be careful about it, but consider it as an option. And then finally, I guess the name of the presentation is Preparing for Venture. So let's talk about all the things you do to prepare, not so much how to deal with the VCs. That is a separate presentation that we regularly do here, and you can see on my YouTube channel. So if you're preparing for venture, it is very likely that you're not going to go right from concept to VC. Happens sometimes. I have clients that take just like we did in the 90s, they take their pitch deck down to Sand Hill Road, where I happen to not be right now, and they get venture funding. Doesn't happen that often, not so much that you should bet on it. It's not a good strategy. Instead, you'll do stage financing with angels, right? Those are those rich people who are willing to put a little bit of money in and take a gamble. The angels will get in when you're at proof of concept stage, sometimes these days at traction stage, but certainly before you're at scale stage. That's venture capital scale. You need money to scale. So before you take money from angels, remember what I said. They're your partners for life, probably. So you want to be very careful about who you take that money to. And I put my angels in the three categories: the good, the bad, and the ugly, named after that awesome Western with Clint Eastwood, one of the great revenge stories of all time. The good angels will give you connections to venture funding. Okay. You want their money because they're going to do their best to get you to the next stage and the next stage of financing. And they're out there. And again, it's not hard to know who they are, even though they're not really advertising. They'll give you mentorship. They got some experience. They've been around. They've done this before. And they know that they're going to win 1 out of 10 times. They know this is risky. It's very risky capital. Yes, I'm going to send you that YouTube channel link in a minute. The bad angels, they don't get all that. Instead, I call them hostage takers, because they get into your company, you find out it's not a good fit. They don't understand what you're doing. They don't appreciate the risk. They don't want to be there for the long term, whatever it is, but they won't leave. They're just there, and you have to deal with them. They complain a lot. I've been through this so many times. They're demanders. They're an annoyance. They're a distraction. They're constantly wanting to see reports and updates, and why didn't you do this? They're second guessing you. They're whiners. The bad are whiners. Be careful about those. It's not the end of the world. It's just a distraction that you'd rather not have. And then there are the ugly. These are the ones that are the potential plaintiffs. They have a reputation for suing companies. If you don't think they're out there, they are. And it's easy to find out who they are. You can just go look at the public record and see who's litigious. And I'm really, really concerned about the angels in this last category, because that will kill a company as sure as anything. I'm so concerned about it that not only will I, if I do my background checks, if a company asks me to find out who they are, I pay attention to who the lawyers are, because you're known by the company that you keep, right? And enough said for that. I'll just tell you, be careful who you take money from. Try to get the good, stay away from the bad, and avoid at all costs the ugly. All righty. I don't think I'm going to be able to get into the instruments, but I just want to say a few words about when you take the angel, when we do the venture capital round, you're going to be selling preferred stock in what they call a priced round. You're valuing the company, pricing the stock. Before then, you're going to sell an instrument that converts into preferred stock. And that instrument will either be a promissory note that's convertible note, or a simple agreement for future equity, which is like a convertible note that never gets repaid. It just converts into equity at some point in the future whenever you sell preferred stock. And the benefit is in both of these instruments is that the early investor, they get the same security that these big bad VCs are going to get. Okay, that conversion feature is automatic in some circumstances. It is optional in others, and there should not be a prepayment feature, by the way. Sometimes that, you see that in documents, but most investors won't let you get away with that. They don't want you to be able to they don't want their money back. They want stock once you're successful. A couple other things to keep in mind. Valuation cap, that's a maximum valuation at which the note or safe will convert. So your investor is guaranteed a certain minimum percentage of the company. So if the value is here when they give you the money, and way up here when it finally converts, they get something in the middle, right? They don't get beat up that bad. Discount, they're going to get a lower price per share. So if you sell me $100, an $80 safe, and it's a 20% discount, that means I'm going to get $100 worth of preferred stock, usually shadow preferred. We won't get into that, but it's very similar to what the investor got. And then if you sell the company and you never do a financing, well, I should get something more than just my money back. That's the change of ownership clause. Two final things. Most favored nation is what you might expect. You sold me a safe that's got a 10 million valuation cap and a 20% discount. And then you went across the street and sold my neighbor a safe, at a 5 million valuation cap and a 30% discount. I should get the better terms, because I'm dumb and I need help, I guess. But it's pretty standard to ask for a most favored nation clause because angel investors just don't do as much diligence. I mean, that's the nature of these instruments. You don't have to spend so much effort. They're supposed to be simple and fast. Finally, pre and post money. Know what that is. We won't talk about it now, but just know the difference between a pre-money safe and a post-money safe. The market standard, because of one very large incubator that is circulating these documents online, is becoming post-money. That is investor friendly. It is not company friendly. In fact, I would call it irrational and company hostile, if you ask me. Unless, of course, I'm representing the investor, then it makes perfect sense. But I'm usually representing the company, and I don't think it makes a lot of sense. Instead, you want a pre-money safe, which makes the math a little harder, but it just makes more logical sense. We have a whole presentation on that. You can find it on my YouTube channel, which has been posted. Now, with that, I am going to open things up. Okay, hold on here. I'm stopping the share. Stop the share. And I'm going to open things up to questions. Put your questions in the Q&A box. But before I do that, I'm going to circulate a couple of links. Some of you joined a little late. So number one, this is how to find me and how to find my channel and my Twitter feed. Secondly, is there anybody here who's in health tech? Because I have created a health tech channel on LinkedIn. And is there anybody here who's in energy tech? That is another big vertical that I'm doing a lot of work in. So there, now you know everything, more about me than my mother now, if you click on those links. All right, let's go to the questions. All right, do we have an office in Southeast Asia? I actually have a lot of affiliates in Asia. Don't have an office there. Well, in China we have offices, but not in Southeast Asia. I have affiliates there that I work with. Somebody's asking if they want me to share the links. Actually, I thought I just did share the links. I'm pretty sure I did, but thanks for that question. Okay, next question. What are some ways that we can know that we're not undervaluing our company when we're approaching others or others are approaching us for investment? Let's talk about valuation for a minute here. Like I say, if you go into this, I know the appraisers are going to hate me for saying this, but if you go into this thinking that valuation is some way to figure out what you're worth, as if you were being sold today, you're going to get the wrong answer. Okay, I think you go into this thinking of valuation as a way to determine how you're splitting up that pie. Okay, so and by the way, if you have questions, put it in the Q&A, not the chat, please, so you can get into the queue, as they say in Europe. So, so think of it that way, first of all. Okay, that's number one. Number two, think of how much equity. This is getting more into when you actually get to the VC, but we'll talk about it now. It's all right. You do not want to lose control, neither economic control nor managerial control in your first venture capital round. You want to have more than 50% vote and 50% of the economics. Sometimes in life sciences that doesn't happen, but as a general rule, that's kind of my rule of thumb. That's where I start from. And then on the flip side of that, the VC is thinking, I need X percent of this company, somewhere between 10 and 40. The company needs Y dollars, so there's our valuation. So you're going to use kind of soft concepts like that to come up with a valuation. I think that's a better way of going about this whole exercise. Now, I know that's not for all of you engineers in the audience. I know you're out there. You know, I can see the slide rules. I know that's not going to be very satisfactory. So again, if you want something that gives you a little bit more comfort, again, take a look at my 30 methods, find 3 of them that converge, get your Excel spreadsheets out, find 3 of them that converge on a number and prove that there you are, and then you've got validation. Now you should hardly ever have to do that, because the way this game is played is you don't ever, if you don't remember anything else I said tonight, you don't ever go to a VC and say, I'm worth X dollars and I'm selling Y% of my company for Z because I'm worth X. If you do that, they're just going to cross that number in half, and that's going to be their offer at best. Never do that. The VC gives you a term sheet and they give you a number. They tell you what they think you're worth. And they do it through this method that I just described to you, also factoring other rights and preferences that are going to be into the term sheet. We do a whole thing on term sheets here. You should go watch it on my YouTube channel. So you'll see how that sausage is made. But that's how I would go about it. Now, every once in a while, I get a company that says, well, I need to get a professional valuation because I'm going out to raise money. Okay, if that makes you feel better, and if you've got an investor that's going to accept that, that's awesome. That's great. Go for it. But venture just doesn't work that way. You know, that's Hollywood. And that's just my experience. That's just my opinion. I could be wrong. Okay, how changeable are the originating documents of a new startup? It seems there's an ever-growing amount of considerations, and down the road, things like golden parachutes and different legal considerations as a company grows in employee size and location. How much of that can be changed in the months and years after inception? Okay, I'm going to answer that question with 2 opposing thoughts. Did you know it's almost impossible for a human to hold 2 opposing thoughts in their head at the same time? But that's what I need you to do. So let's do a thought experiment. Opposing thought number 1, actually it's thought number 1, we haven't opposed it yet. Thought number 1 is that it's super important that you get your company set up right from the start. It's super important that you get, you know, all the right stuff. You get the right capitalization, the right structure. In fact, it's so important that I wrote a whole book about it, and you can have a copy of this book yourself if you go on Amazon and buy one, or if you're here and I'm going to send you a digital copy. That's one thought, and that is very true. There are some things you have that you just can't change once you've started them. Opposing thought. None of this matters a whole lot because you're going to have so many opportunities to reshuffle that economic deck by the time you get to the end. That you shouldn't stress over it as much as people do. Let me give you some real concrete examples. One thing that's sort of immutable is, well, almost nothing is, but if you haven't resolved the founder equity early on in life, if you just haven't resolved it, if you don't have any resolution and the founders don't agree, that's a tough one. That's a tough one. That might tank your company. That might be something that you just can't fix down the road. Okay, let me give you another one. Let's suppose you have resolved it, but now you decided years from now that that's not right, or 10 years by the time you exit. And by the way, it's going to take you that long usually. Well, geez, we messed up our founder split early on because here we are, and 10 years from now, everything's going to look different. Someone's going to leave, someone's going to go part-time, someone's going to double down. We're going to add all these other people. You will have so many opportunities in life to issue more shares, to invoke vesting and take some shares back, to bring in other team members, to dilute some, to increase others. You'll have so many chances that your company is going to look completely different by the time you exit. So that's what I mean. It's kind of a mixed bag. Some things you got to get right from the start. Most things you can adjust along the way. And that's the beautiful thing about the US legal system, by the way. It's relatively flexible in that way. Do you know any good books on the A to Z of different business models? Yes, I do. And hold on here. I've got a couple of them. Here, let me give you two of them right here that I've been looking at that I think are pretty good. Straight Talk for Startups, Randy Commissar, he's a VC. I kind of like what he said. This one's okay, Startup Checklist. But most of my books tend to do with venture and the deals themselves. So what else? Sorry, all the rest of my books are romance novels, so you wouldn't like those. But those are two pretty good ones, and there's a lot of good ones. If email me, I'll give you my reading list, because that's all I do is read startup books, and some are better than others. You know, some have really good, super good advice. Some are just a jumbled mishmash of concepts. I'll tell you which one is which. You don't even have to go to the Amazon reviews. Things startup founders should most be concerned about when it comes to using crowdfunding platforms. Yes, thank you. I gave you three very reputable ones. There are more reputable ones out there. But again, like I said, you're known by the company that you keep. So go see who's on that platform. I have had more than one client, you know, really regret putting their company up on a platform. One of them got scammed. It's a long story. Others of them just ended up being embarrassed because they were on platforms that were not compliant. And there are many of them out there that are like that. But usually the bad thing that'll happen is you'll be on a market for lemons. So they call that a market for lemons. You don't want to be on a market for lemons. You want to be on a market for huge, awesome, successful companies like yours. So just take a look and see who's on the platform. And that would be the biggest thing. The other thing is, this is a technical legal thing, but I think very few companies are getting the security stuff right. I mean, I don't care which platform you're on. I just think, you just wait. I've made this prediction before about other things like option backdating that came true. Eventually the regulators are going to wake up to that low hanging fruit of companies getting the security stuff wrong. So that's kind of the biggest thing. That's what I tell companies when they come to me. I say, yeah, that's a great way to raise money. Just make sure you're legally compliant. You don't want to make it worse for yourself. And a lot of, and here, okay, since you got me started, it's just so easy. It's just so easy these days, to use a Google search instead of a lawyer, right? And, you don't know, it's the unknown unknowns, as Rumsfeld used to say. You don't know, you really don't know what you don't know. And if you don't know that there's a state blue sky filing requirement, and really bad things will happen if you don't meet it, well, you don't even know you violated the law. You won't know until something goes wrong. Another way of saying that is it's not a problem until it's a problem. So what I tell people is get legal advice if you're going to do this. This is a highly regulated area. If there's no public record on an angel, what are some subtle cues or major tells? Why not just ask them, who have you invested in? You're diligencing me. Tell me, who have you invested in? Mind if I give them a call? Now, they may say no. In fact, they might not want you to know. But again, if you know how to use Google, you can find out a lot about anybody. It's super easy to find out if somebody's litigious. That'll show up in a public record. Just go to the county where they live, search the court records, plug their name in, see what comes up. Okay, I have a SaaS practice management app for specialty practices. I don't know if I should read the rest of this out loud. So let me just say that, let's say that there's a question here. Wait a minute. There's a question here about maybe founder succession, we'll say, all right? And also a question about domain expertise and finding talent and building out your team. All right, so here's what I'll say about that. It's really hard, I think, to find that perfect co-founder. And it's really dangerous to be 50-50 co-founders, really dangerous. I can't tell you how many times in my career, and remember, I'm extremely old, so I've done this many times, that I've seen 50-50 partnerships go bad and it's just deadlocked. And a judge can solve that problem, but not many other people can, maybe an agreement or a mediation. So 50-50, I always just cringe when I see that. When I tell people you're likely to fail is when I see a 50-50 boyfriend-girlfriend partnership. And I have never, ever, ever seen that work out. Never once, never. I'm sure it has someplace out in the ether, but I've never seen it. And I still have those deals walk in my office. And I got to be honest, you can call me love's executioner, because I do tell people, I said, just want you to know something. I've never seen a 50-50 boyfriend-girlfriend arrangement work out. That's just my experience. So, but let's say you're there. What are you going to do now? Well, you really need to add team members. You need to add someone that can break a deadlock. You need to add somebody that can, husband and wife works out better because we have a legal mechanism in place for dealing with those disputes. It's just boyfriend, girlfriend are the ones that, seem to be a problem. The stories I could tell you. Anyway, in fact, I will tell you one. I did have somebody call me up and they said, you don't remember me, but years ago, I was really mad at you. You said all these terrible things and, but you made me kind of nervous, but, I didn't go into business. And that guy turned out to be such a rat. I would have given, my company is hugely successful. I would have given half of my net worth away. So thank you for that. Okay, where was I? Yeah, you need to get that third partner. You can get a third director that'll break a deadlock. Hopefully you'll get an equity investor soon that can break the deadlock. But more to your point, the question is, where do you find the talent? And founders, you want people who are going to have equity because they got skin in the game and they're going to work long, hard hours because they're doing it for equity. Oddly enough, the wisdom is they will work harder for stock than they will for cash, even though that you could wallpaper my office here with all the stock certificates I've got that didn't amount to anything, and I wouldn't be taping dollar bills on my wall. I'd be spending those down at the Rosewood. So, oddly enough, though, that being the case, people who have equity, they're incentivized to do the best they can and turn that paper into cash, into money. So founders are good. People that will work for equity are good. That's who you're looking for. Now, in terms of the talent, you want a technical co-founder for sure. I've heard enough VCs say, look, we really want you to have a technical co-founder because we need someone that's going to put in those long hours and weekends and what have you, building out this, and I do tech startups, so that's why, building out this tech product. So you really want that. Now, if you can't get that in a founder, you probably will want to try to get as much as you can through advisors and consultants. And advisors will advise the company on some area that they need help with. Maybe they're good at raising money. Maybe they're good at getting you a customer. Maybe they have domain expertise. You're a fintech company and need someone who knows how banks work. If you can't get a founder who has domain expertise, get an advisor. And again, advisors work for equity. All right, what else we got here? What does M&A mean? It means mergers and acquisitions, sales of companies. Let's see. Somebody's asking what lawyer they should hire. Yeah, that's a real tough one. By the way, let me tell you the difference between lawyers and doctors. I learned this right out of law school. Went to work for this old Irishman and back in Fargo, and client came in and sat down, and it had something to do with medical. I think he was a doctor, and he says, "Yeah," he says, "the difference between your profession and mine," he says, yes, remember, he was a doctor. He said, you just got out of medical school, so you got all the latest, greatest knowledge. If I needed a doctor, I'd sure go to you. On the other hand, if I want to go to a lawyer, I don't want, the law doesn't change that much, or not that much that you're going to learn it in school. It changes a lot in some areas, but through practice and practical application, not through the techniques you learn in school. So if I want a lawyer, I want someone who's been doing it for a long time, and can sit around a table and just kind of know who's going to be problematic, who's going to want to retire early, who's going to get you in trouble, who's greedy, who's sneaky, all that stuff. So that is my view on it. That was not my view in my first year of law school when I first heard that story. Having been out for almost 40 years now, that is now my view. Experience trumps all. My company doesn't have revenue yet. How do I do a financial forecast? You do pro formas, you do projections, and everybody knows there's an element of artificiality to that. We get that because you don't have real numbers, but still you got to have something, not so much so that it'll come true, but you need to show the venture capitalists that you've thought about it, right? That you've kind of done the homework and you've thought about how big the opportunity can be. I have no affiliates in Sydney. I have been to Sydney. I thought it was great. It was awesome. My God, people drink a lot there. What's up with that? But other than that, or maybe because of that, I thought Sydney was a great town. And like I say, The In-Between Man is one of my favorite shows right now. What's the best way for founders to keep a fair amount of equity in the company? Well, the key word there is fair, right? And this is not something that you can hardwire. So the best way for founders to keep a fair amount of equity is not to give up too much equity. And now that sounds a little trite, but it's not. I want you to think about this part of it, because founders don't end up giving up too much equity because they sold preferred stock to somebody and knew they were selling 10%. I mean, everybody understands dilution, right? That's not that big. That's not a difficult concept. Where founders get screwed on this is when they sell convertibles and safes, right? And they don't pay attention to how much of those convertibles they sold because they don't go on the cap table when you sell them. They convert into equity at some point in the future. So you don't really know what it is that you've given up until the preferred stockholder comes along and all that, those convertibles convert into stock. And then when you get to that moment of truth, or when you're forced to actually sit down and do the math and figure out what those convertibles will convert into, you say, my God, if I give the investor 20% and I've given 40% to the safe holders, that doesn't leave much for me. I wasn't very good at math, so I don't know what that number is, but it's probably smaller than what you want. Now, I've had it happen more than once where the investors got involved and said, you know what? We were going to invest in you, the VCs, the institutions. We were going to invest in you until we saw this chart of your safes and your convertibles. And once those safes all convert and you take my money, there's not going to be enough stock left over to incentivize you and all of the other founding team and management. So we're just going to go invest in the next guy that is doing the alternative to what you're doing. That's what you really have to watch out for. So how do you ensure that doesn't happen? You just keep a strong eye on it. Now, there are websites out there. You can go out and download calculators, safe calculators, so you can just run what ifs whenever you want. And some of the commercial capitalization table software that's out there will do that for you. I'm old school. Actually, I'm from North Dakota, so I'm probably more no school. But whatever it is, I like to just get an Excel spreadsheet out and do my own what ifs. Okay, and just decide from time to time where I would be if I took this much money, this valuation today. So make sure that you do that. All right, make sure you put your questions in the Q&A box. I've got 7 minutes left. Is it possible to get separate safe deals from separate investors at different terms? Yes, that's one of the reasons you use safes. They can all be different. And it'll drive you crazy when you do the math later, but that's what you got me for, right? But yeah, you can have different terms for different safes, and we regularly do. We regularly do. And if somebody's smart enough to get that MFN clause, remember that, most favored nation, that'll certainly discourage you from doing that, but it still gets done. I don't know what Welcome Solutions is. Someone asked if that's part of my channel. Maybe I sent you the wrong link. What's the name of your book? My new book is going to be called 10,000 Startups, so watch for it. My old book is Dead on Arrival, How to Avoid Legal Mistakes. Yes, you can read it online. I'm going to be sending you a copy by email. Co-founders in good countries. Is that good, bad, or ugly? That's okay. That's all right. Nothing wrong with that. You know, these days with Zoom, it's like being in the same room with somebody. In fact, sometimes it's better than being in the same room with somebody, especially if they're, people you don't want to spend that much time with. So different countries is not a big deal. Yeah, I guess it is a big deal if your venture capitalist is in one city and they want to know they can go across the street and sit down and meet, the co-founder. But even the VCs now are getting way better over these last 2 years about not having to be in the same place as the companies they're investing in. Let's see, what do investors want to see in a cap table? Yeah, I wish I could share a form here, but I think what you mean by that is not what does a cap table look like, but what do they want to see? They want to see the founding team have significant stake, significant amount of stock in the company. They want to see that it's subject to vesting, so they'll stick around. They want to see that there's enough there for them to be incentivized. That's what they're going to want to see. Someone wants a list of good, bad, and ugly VCs. Not in a million years am I going to publish that. Just trust me, we all know who they are. I don't want to get sued. You said earlier that with documents, most things you can adjust along the way, and some things cannot get adjusted. Yeah, read my book. I got a whole list of what can be fixed and what cannot be fixed. The one big thing that can't be fixed is that people just don't document anything. Everything else, once you've got a stake in the ground, we can adjust from that stake, right? If we got an agreement, if you have nothing, in writing, it's like playing tennis without a net. You've got nothing to adjust from. I am awesome with metaphors tonight. This is a new record for metaphors for me in one night. Someone should call the Guinness Book of World Records. Jennifer, I hope you're keeping track. Is Miss Fitness still here? Maybe not. Okay, I'm looking for a CEO. Where do I find those? Yeah, I wish there were a CEOs are us. There is a site called Founder Dating you might check out, but that is the biggest problem. It's one of the reasons that we all come to Silicon Valley, this rainforest we have here, where we can just go out to events like Rob's Idea to IPO events that we used to have. These days, by the way, I'm having a big party at the end of this month out at the Rosewood. You're all invited, and you can come and you'll meet people, and you'll probably find yourself a CEO there, because here in Silicon Valley, there's just so many people that do so many things. Odds are, if you hang out at enough places, go to enough startup events every night of the week, like you used to be able to here, you'll run into people that you want. Other than that, I don't know. I don't have good advice for you. I'm not sure. If you find out, tell me. Is there a generic form with fill in the blanks I can give to investors? There is, but I don't use it. Don't do it. You'll be sorry. This is not the kind, it's like brain surgery, right? You can probably Google the instructions for do it yourself brain surgery. Don't recommend it. What are the best ways to get truly mission aligned investors? Oh, there's a good question. Themed events every once in a while. I think that's a great way. Like a lot of the investors these days, because of Zoom, it's just so easy for people to go out online and do events and to tell you about themselves and what they want to do. We're doing a venture capital panel right here at a venture capital panel right here at Idea to IPO next week on energy tech. So those are, climate tech mission. If that's your mission, come to our panel. And we do a lot of those. I'm doing another one a month after on health tech, precision medicine. So I think it's relatively easy to find those folks. Unfortunately, I'm just not going to get through the rest of your questions here because we are about to run out of time. So I'm going to take one more. And the question, the winner is, envelope please. The winner is the person who asked, what are your thoughts on setting up 4 classes of stock with voting shares only in one class? Well, 2 things. Number 1, you should never do that. Number 2, I just did that this morning. In fact, it was 4 classes. In fact, is that you? No. I don't like it, but we see it sometimes. And Zuckerberg ruined it for everybody because he got away with it. And so did the founder of, who was it, Zynga or Snapchat or somebody. So a couple of very high profile entrepreneurs got away with have different classes of stock that have like super voting for some people, for founders, and regular or less voting for others. Yeah, that's right. Class A, Class B, Class C shares, Class F shares, Series F, Class double F. But here's the thing. I don't like it because your VC, what I tell people is when you get to the VC round, they're going to make a pancake out of whatever you've done. They're going to make that go away. They're not going to like it. They're not going to like one person having that much control over the company. So it's a temporary solution. Now, Facebook has proved me wrong because that's a solution that went all the way to IPO. But for most companies, it's a temporary solution. So I'd rather not have the brain damage of trying to put it in place and explain it to everybody. So I don't like it, but I'll do it in the right case. Sometimes there is a right case. Okay, I'm sorry I did not get through all your questions. Feel free to email me. You can always set up office hours with me if any of you want to chat. It's late, at least where I am. You can email me. You can send me a link on LinkedIn, and let's continue the conversation. You've been a good audience. I wish I could do an encore. I wish you could clap and cheer and just bring me back to the stage again and again, but man, I got to go to sleep. And I got to see the next episode of The In-Between Man for our Australian friends. So thanks for being here. Thank you for being here tonight, and we will see you next time.